Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if Constellation Brands stock is a buy. Constellation Brands, stock ticker symbol STZ, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. First, special thanks to Pongot for suggesting this analysis. Now let's start with some background info on Constellation Brands. Constellation Brands was founded in 1945, but this isn't your grandpa's dusty winery. In 2013 the company made one of its most important acquisitions when it acquired Grupo Modelo's American beer business from Anheuser-Busch. This acquisition allowed the company to vertically integrate the production of their beer business and supercharged growth. Today Constellation Brands is based in New York with over 22,000 employees across the globe. The company has grown to include such famous brands as Modelo, Robert Mondavi, and High West Whiskey. These are just a few gems in their constellation of high-end beers, wines, and spirits. Now let's look at the price action. Starting with the 1-year chart, we see that Constellation Brands had a CAGR of about 3%. Zooming out to the 5-year chart, we see that Constellation Brands had a CAGR of 9%. Constellation Brands share price has been a slow and steady gainer but does not show signs of rapid growth. If we perform a backtest comparison of investing $10,000 in Constellation Brands versus the S&P 500, we find underperformance for Constellation Brands. In that comparison with the S&P 500, $10,000 invested in Constellation Brands would have shrunk to $11,469 or a 2% CAGR versus $18,848 or an 11% CAGR if invested in the S&P 500. This demonstrates tremendous underperformance for Constellation Brands. Additionally, a Constellation Brands investment would have been more volatile with a 26% standard deviation versus 18% for the S&P 500. Constellation Brands also underperformed the S&P 500 in terms of the best year performance, for which Constellation Brands grew 20% versus S&P 500 31%, and worst year performance where Constellation Brands fell 29% versus the S&P 500 18% fall. In terms of max drawdown, Constellation Brands fell 37%, more than the max drawdown of 24% for the S&P 500. Constellation Brands also underperformed the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Clearly investor money would have been better spent in the S&P 500. Now let's hop over to market share and take a look at Constellation Brands' market share. So we come over here and type in the ticker symbol for Constellation Brands and see that the market share is 1.1% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This means that a little over 1% of all money spent for food or beverages goes to Constellation Brands. The 5-year market share CAGR for Constellation Brands is -3%. This means that Constellation Brands' market share continues to shrink year after year. If we start in 2019, we see that the market share was 1.2% and 1.3% in 2020. It then fell off a beer fountain waterfall to 1.1% in 2021, 1.1% in 2022, and 1.1% over the trailing 12 months. Some other companies are drinking Constellation Brands under the table, and unfortunately the trend shows no sign of reversal. Let's take a look at the fundamentals. Gross margin is 50%. This is on par with other adult beverage companies. Revenue has compounded at around 4% over the past 5 years and has reached over $9.79 billion most recently. There is certainly a market for getting fucked up at house parties. Looking at cash flow, we see a 4% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 7% CAGR. As a result, free cash flow has grown at a 3% CAGR. With capex increasing and operating cash flow growth slowing, free cash flow has actually been in decline since 2021. This does not bode well for the company's future. One thing the company is doing well is buying back shares. Weighted average shares outstanding have fallen over the last 5 years, going from 195.5 million shares in 2019 to 191.2 million shares most recently. Constellation Brands has done a good job buying back shares. Though the rate of buybacks is not particularly high, buying back any amount is helpful for shareholders. Now let's view return on invested capital. Return on invested capital has risen from 9.3% in 2019 to 10.6% in 2023. It must be noted that the ride was bumpy and not in a straight line up and to the right. It looks like Constellation Brands goes through waves of efficiency only to return to inefficiency. I would like to see more consistency. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 174 days in 2019 to 95 days most recently, Constellation Brands has gotten a little more efficient over time. This may actually indicate that future efficiency metrics might show improvement soon. Now, let's look at Constellation Brands' debt. The net debt to EBITDA has fallen over the past 5 years, going from 4.6 in 2019 to 3.1 most recently. The company seems to be doing a good job of paying off debt over time. I would not expect this to become an issue for Constellation Brands in the near future. Last, let's explore dividends. Current dividend yield is 1.5% with a dividend payout percentage of 43%. Constellation Brands is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at a 4% dividend per share CAGR over the past 3 years and a 6% dividend per share CAGR over the past 5 years. Constellation Brands' dividend history is clearly healthy and looks to continue having growing dividends per share going forward. The fundamentals of Constellation Brands are decent. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Constellation Brands. It is a beverage company with a gross margin of 50%. The 5-year revenue per share CAGR is 4% and the 5-year free cash flow per share CAGR is 3%. This is a slow and steady revenue and free cash flow growth combined with a good gross margin. A return on invested capital of 11% is okay, but it seems to be growing. Next, the cash conversion cycle of 95 days is high, but I have never seen an alcohol company with a low cash conversion cycle value. Concerning debt, a net debt to EBITDA of 3.1 means that it would take Constellation Brands a little over 3 years of earnings to pay back their debt. So from a fundamental standpoint, Constellation Brands is okay. Now let's switch our attention over to valuation. Constellation Brands is slightly overvalued relative to the S&P 500 with a ratio of 1.2. The price to earnings growth, or PEG ratio, is 2.6, indicating that Constellation Brands is overvalued relative to their projected earnings growth. Constellation Brands has had steady growth over the past 5 years. However, this growth was not enough to maintain its market share expansion. While there are other important factors besides market share, investing in companies that are growing their slice, regardless of if the pie is growing or shrinking, is very important. That being said, Constellation Brands has done a tremendous job assembling a portfolio of strong brands. In fact, under Constellation Brands, Modelo has risen to become the top-selling beer in the United States. Additionally, the world's best-selling beer is made by Constellation Brands. This then raises the question, why is Constellation Brands losing market share when they have the best-selling beer? There may be a couple of reasons. One reason is that beer sales in general have been on a decline as wine and spirits have been experiencing tremendous growth. This means that the beer pie is shrinking, though Constellation Brands' slice is getting bigger. This also highlights a big strength of Constellation Brands in that they produce beer, wine, and spirits. When compared with companies focused solely on beer such as Anheuser-Busch or only wine and spirits such as Brown-Forman, Constellation Brands' diverse portfolio allows them to leverage consumption trends in all adult beverage categories. All in all, Constellation Brands is probably one of the strongest in the adult beverage space. However, the declining market share and low return on invested capital are not good signs for me. For now, I will avoid putting it on the watch list, but the company is in a great position to turn things around. Many thanks for watching. What do you think about Constellation Brands? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.